And welcome to this week's look at the major news stories affecting the market so far. A bit of a mixed bag. We're going to focus quite a bit on inflation this week, obviously, with figures out over the last few days. First of all, we're going to start with the FTSE 100 and its continued attempt, or is it just a pipe dream, of reaching the 8,000 figure. We'll also take a look at a couple of currency pairs, starting off with the New Zealand dollar against the US dollar and what happened after New Zealand inflation figures came out. Thirdly, we'll take a look at actually that big inflation data that came out from the States and the impact that's having on several markets. And finally, almost to back up that data from the States, we're going to take a look at what's been happening with the dollar and the Japanese yen over the past few days. So we're going to start with the FTSE and the holy grail, if you like, of the 8,000 point mark. Now, obviously, the FTSE 100 is made up of the 100 most highly capitalised companies in the UK. It represents, or they represent, I should say, more traditional bricks and mortar businesses in more sort of grey suit sectors such as transport, construction, energy giants, retail chains and pharmaceutical companies. We contrast that with, say, the NASDAQ in the US, for example, which is pretty heavily tech focused, a bit of a bastion of volatility, I think it's fair to say. Includes the Magnificent Seven of Silicon Valley and a raft of startups via SPAC or SPAC listings. So quite a different constituent makeup. But the FTSE has been relatively buoyant recently, but did stop just short of that magical 8,000 mark. Start of April, we saw 7,978 after a month-long rally through March, including one or two pretty decent-sized increases. But that sort of eased off slightly. We open up Monday of this week around the 79.25 mark and have pretty much bounced around for the rest or the remaining 3 or 4 days of the week. And at the time of recording, we're circa at the 79.50 mark. That easing came off the back of a bit of news last weekend and stories of a 1% fall in house prices in the UK. Now, not hugely significant, to be fair, 1%. Not massive, but it's been talked about for a while and really does give, further backing to an uninspiring outlook to a reasonably well-organised but stagnant UK economy. And the end of last week, we had Jeremy Hunt, who's Chancellor of the Exchequer, the UK's version of the Finance Minister, who basically alluded to inflation being at a 2-year low, but prices are still rising and we still have a cost of living crisis. So all of these factors jumping together and hitting the housing market. Now, compared to the US's go-getting investment-friendly method, the UK is certainly, shall we say, plodding along in a more conservative approach to financial markets and overall economic policy. Distinct difference between sort of the major indexes and drivers between the two countries. But it does mean we probably get in the UK fewer heart-stopping boom and bust, which you could say equals a little bit more stability. However, does that mean that despite having significantly lower national debt than the US, for example, fewer contagions from collapses of vast institutions, like we've seen in the States, not so much in the UK, that British investors may have less risk, or should we say less appetite to risk, but as a trade-off expect and have to understand there's potentially slower returns. Which method is right or wrong? Nobody knows, but it does show quite a clear difference in the steadiness of the UK as compared to some of the boom and bust in the US. But the big thing over the next week or so is going to be what news could drive the FTSE past the 8,000 level, or in fact, are we going to see further information that causes us to fall further away? I think it's going to be quite volatile, so don't forget your risk management techniques. Right, second up, we can take a look at the New Zealand dollar and the New Zealand dollar against the US dollar in particular. And that rose after the Reserve Bank of New Zealand's decision based on the latest inflation data. So Wednesday morning saw the Reserve Bank of New Zealand keep rates unchanged at 5.5%. That's the 6th time in a row that they've held the level at that rate. Now, the Reserve Bank of New Zealand said that rates should remain high for some time to ensure that inflation is contained. Now, the decision came as expected. 25 out of 25 analysts had predicted no change. So not massive news. Statements around how much longer or that these high rates will be in place for some time did have a bit of an impact. However, the New Zealand economy is in recession. GDP is contracted in 4 out of the last 5 quarters. That has prompted some speculation amongst investors that we will see rate cuts perhaps in the second half of 2024. But the initial reaction was a slight strengthening of the New Zealand dollar against the US dollar, rising to an April high. If we take a look at the chart, that shows us that 2024 has seen the formation of a downward channel, which we can see in red. The 1st of April, though, we had an upward impulse form. That's the blue lines that you can see on the chart, which saw the price rise from the low of the year and reach the upper half of said channel. Some key levels there, 0.6077 looks like it's going to be some key resistance. That was previously support, as we can see from the blue arrows, and certainly may well provide an obstacle to growth within those blue lines, indicated by the red arrow, as was evidenced April the 9th to the 10th, sort of stopped really the New Zealand dollar pushing on further off the back of the news. The RSI also indicates that the market is overbought, so we could potentially see a pullback. May well be driven, we were thinking yesterday morning, with the US reports that were due out Wednesday afternoon, and to be fair, it did. We're at circa 0.5990 at the time of recording. We'll get onto that rate decision and inflation data in just a moment, but certainly an interesting time for the New Zealand dollar, despite recession in the country, a little bit of a fill-up in the first half of this week. Okay, third up, and we're going to take a look at the inflation data from the US. We just hinted there that actually it had some effect on the rate between the New Zealand dollar and the US dollar, and that turned slightly, but the data on the consumer prices and core inflation came out higher than expected. Core CPI month on month actually was 0.4%. There was an expectation of 0.3%, and the previous was 0.4%. CPI on an annual basis, actual came in at 3.5%. We were expecting 3.4%, which was above the previous figure of 3.2%. But obviously the figures came in slightly higher. And that basically means the expectations of rates being unchanged in June has risen massively. According to the CME Fed Watch tool, before the news, unchanged in June was around at 42.6% probability, with the majority expecting a rate cut. Post the news, that has actually changed to 83% expecting an unchanged interest rate in June. Quite a dramatic change and a bit of a shift for the markets. Now, Larry Summers, who's a former US Treasury Secretary, said to Bloomberg that cutting rates in June would be dangerous and possibly an egregious mistake. And he said that you have to take seriously the possibility of the next change in interest rates would actually be a further increase and not a change. Quite strong rhetoric from him there. Well, the dollar obviously rose off the back due to the expectations of the tight monetary policy lasting longer than was initially expected or even recently expected. Take a look at a little snapshot of a couple of markets. The US dollar against the Swiss franc hit a 6-month high, for example. Bitcoin fell, but to be fair, that has recovered since. And gold tested the support level at $2,320 per ounce. And the stock market was under pressure. If we take a look at a chart, NASDAQ 100, price is moving in an upward trajectory. We see that in the blue lines, but rounding indicates demand is decreasing as hopes of an interest rate cut seem to be being exhausted. We can take note that it couldn't overcome the resistance at 18,400 to reach that upper blue line. And after the news on Wednesday, it fell to the lower blue line, which may well now act as support. In the near future, looking at this, it's a little bit confusing, a little bit topsy-turvy, but in the near future, the market may consolidate between 17,800 and 18,400, this sort of support and resistance we're seeing at the moment, as the focus shifts to the Q1 2024 reporting season. Perhaps those will provide some further drivers one way or the other for the market. So possibility of consolidation, but certainly going to be price action in between. Again, don't forget your risk management techniques. Okay, and to finish off this week, we're going to look at a particular US dollar pair in the FX market off the back of that inflation data, and that's the US dollar against the Japanese yen. It rose to its highest since 19 153.90. Thursday morning was circa 153.20 of yen against the US dollar, and that is primarily off the back of those US inflation figures we've mentioned. In fact, the yen has weakened to levels last seen in mid-1990. There was an important bullish breakout of 152 yen to the US dollar. Back in 2022, when we reached the level of 152, the Bank of Japan and the Ministry of Finance were forced to intervene 3 times because on their basis that's an excessive valuation. And in 2023, that level has also acted as a barrier to growth. So quite a significant breakout there. Let's take a look at the chart and see what that shows us from a technical analysis point of view, where the price has reached the upper boundary of the ascending channel, shown in blue, which now demonstrates its role as resistance as we move forward potentially. The RSI indicates that the market is strongly overbought. At the same time, can we assume that the likelihood of intervention by the Japanese authorities has increased? They've done it before, and in fact have recently said they did not rule out steps to combat these excessive fluctuations in the value of the yen. So that's fundamentally going to be quite important on top of the technical analysis. So based on that, it is possible we would see a pullback after this strong bullish impulse, with potentially 152 acting as support, or could we actually see us go through that? An awful lot of factors to come into play here. An intervention and talk of intervention is going potentially to be used over the coming weeks to try and prevent some of these fluctuations. So it's fair to say volatility may well increase as well, particularly around interventions. So don't forget your risk management techniques. Keep your eyes and your ears open to the news as well as your charts and technical analysis. And we wish you luck with your trading in the week ahead. Bye for now.